Hi, good evening. My name is César Toledo. I'm a international taxation lawyer, and I'm the host of this program, which is International PodTax. Today we have a really nice program. We will talk about the index provided by Tax Foundation, and we have a really nice guest. The first guest is a U.S. economist, Mr. Daniel Bunn. Daniel is a vice president of a global project at the Tax Foundation. He works as a researcher in international tax issues with focus in tax policy. He was one of the specialists who works in this index, and we are really happy that you are here, Daniel.
Happy to be here. Thank you, Cesar.
Thank you. And we have also Mr. Eduardo Torretti. Mr. Torretti is a partner of Torretti & Co. And he's an international tax specialist. And he works in Santiago and provides legal services to domestic clients and also international clients. So very welcome, Mr. Eduardo.
Thank you very much, Cesar, for the introduction, and many thanks to International PodTax for this invitation. I'm happy to be here.
I'm happy that you are here, Eduardo, also. So, as a starting point, and we will talk about this International Tax Index. Mr. Daniel Bunn is going to talk about this, and he's going to show some slides. Mr. Daniel, right?
Sure, absolutely. And thank you again. So the International Tax Competitiveness Index was originally launched back in 2014 as a way to study the different tax systems of developed countries. The index looks at OECD countries, of which Chile is a member, and Chile, of course, shows up in the index because of its membership. Tax Foundation is a think tank in Washington, D.C., and our goal is to educate policymakers, not only in the U.S., but around the world, about principled tax policy. And the index is one of our main tools for doing that, because not only are we able to compare different tax systems around the world, but we're able to use kind of our lens, what we think of as good tax policy, to show countries where they stand out relative to either the worst or the best, or if there is a particular part of their tax system that is particularly unique or hard to comply with. And the index builds on two key principles for tax policy. The first one is neutrality. We know that taxes distort economic decisions. They distort decisions on whether to invest, or sometimes on whether to save, or they can influence decisions on whether to buy one good or another. But our question is, how much does a tax system distort economic decisions? And we compare tax systems on relatively less distortionary tax systems versus those that have multiple layers of taxes and multiple compliance burdens that can really cause a country to be, first of all, low ranking in the index, but also potentially have slower economic growth or lock in different behavioral aspects. And then we also look at competitiveness. One of the things that the index is really valuable for is looking at countries in context of what other countries are doing and saying whether one country has high marginal rates or another has low marginal rates, and then also comparing different pieces of the tax system. The International Tax Competitiveness is a relatively broad index. We look at 5 different areas of tax policy. We look at corporate taxes, individual income taxes, consumption, property, international tax rules. And for each of these, we have multiple variables. We look not only at the corporate tax rate, but we look at the treatment of losses. We look at business investment treatment through depreciation schedules. We look at individual taxes. We look at how progressive or flat a tax system is. We look at compliance costs. We borrow a measure from a PwC study for compliance costs for business taxes. And the International Tax Competitiveness Index can be a relatively powerful tool when you think of the distance between the best and the worst countries in the OECD. And we look at these things through kind of a lens of how well does the tax system minimize economic distortions and also minimize the number of layers that a tax system has. Some countries have multiple layers of taxation, which can increase compliance costs and increase the distortions. So the best systems are those that have relatively low marginal rates, relatively straightforward design. It looks as if someone actually had a purpose in mind when they designed the tax system, and they generally have lower compliance costs. So the top 5 countries in the index are Estonia, Latvia, New Zealand, Switzerland, and Luxembourg. And I'll point out a few unique features of these countries. So Estonia and Latvia have what we like to refer to as a cash flow tax. So for businesses, if you're a business that earns profits, those profits are not taxed until they are shared with shareholders, until those profits are distributed. So if you hold your profits within your business, you're reinvesting those profits, those go untaxed. Only when the cash flows out of the business do those businesses get taxed. And they have relatively low corporate tax rates, as alongside broad VAT bases. And I think New Zealand is a good example here. New Zealand, from an economics perspective, has one of the best VAT bases in the world. A VAT system, or goods and services tax, or broad-based consumption tax, whatever you like to call it, is best when you have a very broad base. A lot of countries have value-added taxes with special exemptions or special lower rates, and these increase not only compliance challenges, but they can increase the influence of the tax system on consumer purchases. New Zealand has a very broad base and is able to collect a substantial amount of revenue through its goods and services tax because of that broad-based design. Switzerland and Luxembourg have other important features, but I think one of the key things with all 5 of these top 5 countries, and this is particularly interesting for Switzerland, is the low compliance burden. The time it takes for businesses, for individuals to comply with the tax code is very low. Now, I say the index is powerful when comparing the top 5 and bottom 5, and I'll show you why. So when you look at these different tax systems, these top 5, again, you can look at what has been decided, and you can say, okay, it looks like someone had an overarching purpose when designing this tax system for not only raising revenue, but also for making sure that businesses and individuals are able to comply and not distort economic decision making. At the other end of the scale, you have the opposite story. So these are the bottom 5 countries in the index. You have France, Portugal, Poland, Chile, and Italy. And in each of these systems, you're going to find, especially on the property tax side, a lot of various different tools for taxing, in some ways, the same value. You might have a general property tax, and then on top of that, you might have a wealth tax, and then you may also have a real property transaction tax. You may even have, like France has, a financial transaction tax. And all of these different tax tools, from the index perspective, hurt the country's ranking, especially because each of those different tax tools can have different distortionary effects. And we're not saying you can't necessarily raise the revenue that you have through those different tools, but that it would be better to raise that amount of revenue through maybe one tax tool rather than 4 or 5 different ones. We recognize that different countries have different objectives, but we look at all these different layers of taxation and say that it doesn't necessarily make sense. Now, another thing that you find in a lot of these countries are not only multiple layers of taxation, but multiple layers of incentives. So instead of designing a corporate tax system with a main rate and depreciation schedules for different assets and losses and loss carryforwards or loss carrybacks, a lot of these countries have patent boxes, special lower rate for certain types of income, R&D tax credits, And from our perspective, it would make sense to design the corporate tax system with just any business activity in mind and not try to specialize the tax system for particular activities. Now, for Chile, as you can see there, ranked 35 out of 36. This covers the 36 OECD countries. For Chile, here are a couple of the different aspects of the Chilean tax system. These would be familiar to you, of course, Cesar and Eduardo, but for our audience, just running through some of these things. Now, some of these are strengths. Some of them are kind of middle of the road indicators of just where the tax system is. But then others are just real weaknesses when it comes to the International Tax Competitiveness Index. So the 25% corporate tax rate, that's just a little bit above the OECD average, not too far out of line with other OECD countries. The unlimited loss carry forwards for corporate taxes is an efficient way to design a tax base so that you are kind of balancing things over the business cycle so that when times are bad, those losses get carried forward against profits when times are good. That doesn't mean that there are no corporate profits to be taxed, but it means that it's going to be counter-cyclical, which is a good thing for a corporate tax system to be. We see that labor and consumption taxes are incredibly complex. Something like more than 100 hours on average to comply with labor taxes in Chile. These are labor taxes that fall on the business to collect and remit. So the Social Security and different contribution types, payroll taxes. And then Chile has a worldwide taxation system. So when it comes to international tax rules, Chile, I believe, is the only OECD country that taxes business income at the same rate and base, regardless of where that business activity is in the world. Most countries have moved to what we call a territorial tax system that allows businesses essentially allows businesses to bring foreign profits home without additional tax. Now, I'm going to talk a little bit about my home country just for context on what might change, or how different countries may adopt different systems and things like that. So the U.S. Is ranked 21st in the index overall. Again, a corporate tax rate. This is combined state and federal corporate tax rate of 25.76. But we have immediate deductions for machinery and equipment. Chile has very long depreciation schedules, which kind of biases against investment. But the U.S. adopted this immediate deductions for machinery and equipment as kind of a pro-growth, pro-investment measure for the tax system in the U.S. We have a relatively high top personal income tax rate at 46%. And then the U.S. also has one of the highest real property tax burdens in the OECD. Now, we don't have a wealth tax currently. Who knows if we will adopt one in the future. But the real property tax burden, this is a tax that is normally developed and enforced by local governments. And this is a funding mechanism for the public school system in the U.S. A lot of times it's the main or the largest source of funding for school systems. And it's one of the highest among the OECD countries, this real property tax burden. Now, the U.S. rank improved after tax reform. Previously, we had ranked 28th on the index. That was the 2017 rank for the index. But after the adopting tax reform, we improved the corporate rate. We have immediate deductions for machinery and equipment. And we adopted a territorial tax system. We made that transition from the worldwide system to a territorial system. And I think it's worth also commenting before I close off my comments and hear from Eduardo, and then we move into the later discussion, is, of course, we just had an election, and there were different views of tax plans and things like that. So one thing that I did with the index is I tried to look at the different plans from the Biden campaign and see how it would change the U.S. ranking. And it turns out that it would kind of reverse a lot of the progress that was made in Tax Cuts and Jobs Act. The federal corporate tax rate might go up to 28%, increase the top personal income tax rate to the pre-tax reform level, higher taxes on dividends and capital gains, and the U.S. rank would if Biden were able to get all of his tax proposals adopted, move back to 30th. So I think it's important to think about how these different policy decisions could impact competitiveness, impact investment decisions, distortions, and economic growth. I'm going to stop sharing my slides, and then we can, move into hearing remarks from Eduardo, and then a discussion.
Wonderful, Daniel.
Thank you. Thank you very much, Daniel. I'm very clear. Just before moving to general comments and to speak broadly about the situation of Chile within this ranking, could you just explain us a little bit, how do you build this index in terms of, is it like a sort of point system, and how do you allocate points for the different criteria that are evaluated? Is it something very mathematical or?
Sure. So for every subcategory, like say for corporate taxes, I think we have 8 or 9 variables for corporate taxes. And within that grouping of variables, we have, these sub-indexes. So we have something for the corporate tax rate. We have something for the tax base, which includes the different depreciation schedules. It includes the treatment of business losses, treatment of inventory, and then we also have incentives and complexity. And within each of those, we have essentially equal weighting of the different variables. And then it gets aggregated up. And what we do, we don't, go out and say, oh, we know Estonia is going to be the first, and then just rank everybody off that. We put everybody kind of in a, even footing before the data gets put in, but then everything is ranked relative to the best of every category. And when you have everything relative to the best, and Estonia happens to be, at the top of the category, that's how you get these relative rankings. So essentially, Chile ranks 35th relative to Estonia. We don't have this absolutely perfect tax system in mind. We just take what is out there and rank things relative to that. Is that helpful?
Sure. And one last question about the construction. How spread is the difference between the first and the last one? Meaning it's just a ranking from 1 to 36, or in between there are some differences, because sometimes being the number 35th might be a little tricky, because probably from number 10 to 35 the differences are very little.
Yes.
So how worried should we be in the Chilean system, since we're not, it's not great news to be ranked in number 35. Is it very spready in the last part, or there are huge differences?
So we do, the ranking comes after we do a score. The score runs, I'm double checking here, runs from 100, which is Estonia, all the way down to, I think, the mid 40s. So Chile's score was about 46 out of 100 points in the 2020 version of the index. Now, the distribution certainly is concentrated kind of in the middle. There are a lot of countries with scores in like the 70s and 80s. And it's, it's not a perfect curve, but it's essentially that. So you have Estonia, Latvia, New Zealand, Switzerland way over here, then a lot of countries in the middle. And then Chile, Italy, France, those countries are essentially out at the far end. I think all of those countries have scores below 50.
Sure. And since when we have been evaluated in this ranking? Since its very beginning in 2014, or?
I believe Chile was part of the original ranking, but every year we are always updating little bits of data or methodology, and every year we take the latest methodology and we do what's called a backcast. So we look all the way back for all countries with the current methodology.
Sure. Well, I have a general remark to start with after these questions that pointed to the methodology. I'm not surprised with the Chilean ranking because, first of all, in the last, I would say, starting in 2012, and mainly from our tax reform we had in 2014, then 2016, and now again in 2020, I would say all these tax reforms brought additional complexities to our system. we are, and we've been in the last, I would say, 8 years in a very strong political discussion. And when you have, political movements all around, you always talk about taxes, and taxes is a very sensitive thing, right? In public policies in general. And we had two governments of different political, wings. So all this tax discussion has been over and over for the last years. And I would say for the size of our economy and our market and the Chilean diversity that we have, economic diversity, if you go and talk to different, serious policymakers and economists and lawyers, I think you will have a common answer that our tax system is far too complex for our reality. And sometimes, and after we went inside the OECD, I think we were a little innocent, I would say, and to pick up certain specific policies and tax, policies, and sometimes they don't, or they were not designed or drafted for the Chilean reality. And sometimes with a goodwill, I mean, with trying to be a good student and making a good effort, sometimes for the Chilean reality, we have picked things that are too complex for our economics, volume and our side, for our auditors and for our professional reality in terms of professional services and tax auditors. I mean, from
Sorry, Eduardo, when you say our reality, you mean the economic.
Because I mean, I'm going to this point. I'm not surprised, and please, Cesar and Daniel, I would like your opinion on this. I'm not surprised if you go to the top 5 that you would see in general small economies, right?
Yeah.
Small economies in terms, well, I'm not a huge economy. I'm not perhaps full of natural resources. I don't have all the multinational companies coming to invest in my domestic economy. So why should I, put things too complex? Perhaps I should try to make things easier and have a very raw taxpayer system, not necessarily in the terms of the tax rate, but in terms of, the tax administration, in terms of the complexities and so on. So if you compare Chile to Switzerland or to New Zealand or perhaps to Australia, these are economies that we would like to be compared with, right? We don't compare ourselves with Germany or with Spain or with the US, huge domestic markets, a total different reality from ours. But we do want to be compared, perhaps with Portugal. Portugal is not doing very well in this ranking as well. But then, so I think that we are sort of, picking different policy regulations in terms of taxes for economies and jurisdictions that are not the ones that have our local reality, and that would be my point. I don't know if you share my opinion.
Share your thoughts, Daniel.
I think you're absolutely right to note the size of the economies that are highest ranking in the index. I think as you get, honestly, I think the largest high-ranking country is Germany, and I believe it's ranked 15th in the index. So it's a lot of relatively smaller economies, smaller countries, and a lot of Eastern or Central European countries in particular that have had, and especially for Latvia and Estonia, they had a chance, about 30 years ago to start from scratch and to rebuild a tax system kind of with intentional design. But also, as you mentioned, New Zealand, Australia is ranked number 9th in the index. These are countries that have relatively, again, efficient and rational approaches to tax design and tax systems. And I think it's important to think and keep in mind, like Eduardo is saying, that the competitive advantage of large countries with large domestic markets is very different than a smaller economy that's trying to stand out from the crowd, especially in the context of competitive pressures in South America. I mean, Chile is the only real, other than Colombia that recently joined the OECD, but one of 2 OECD countries in South America. We'll see if Brazil joins in a few years or not. But I think it's important to see that and say maybe the tax system should be designed from a kind of customer service perspective, not just for foreign businesses. That's not the design. That's not the full purpose here. It's for domestic businesses, it's for domestic consumers, domestic individuals, for them to be able to succeed and compete, in addition to attracting foreign investment.
Yes, and what I also read from your comments and looking at the ranking itself, it's not only a matter of tax burden, because New Zealand and Australia are not, we would say, low tax jurisdictions, not at all. Individuals are heavily, taxed in those jurisdictions. And in the Gini test, because equality is something that comes in always in tax discussions, there are countries that are pretty well located, better than our economy in the Gini ranking. So still, you can have an efficient tax system, a very competitive one, and still have a decent or a bigger tax burden than what we have in Chile. So what I would read of your comments and this ranking is that it's a matter of efficient policy making, and not only a matter of having high tax burdens or lower tax burdens. It's not only a political discussion. It's good quality policy making or bad quality policy making.
Yes, I think that's absolutely right. We had, when we published the index this year, we had someone who tried to do that correlation between tax burden and your ranking on the International Tax Competitiveness Index, and there's no relationship. You can have Sweden, I believe, is ranked number 7, and it has one of the highest tax burdens in the OECD. France has, again, one of the highest tax burdens in the OECD, and it's ranked in the bottom 5. So yes, it is about policy design, intentional design for minimizing complexity, minimizing distortions, and paying attention to what the real levers of tax policy are for individual, I'd say, labor supply and business investment.
Yes.
About that, in going, sorry, Eduardo.
No, please go ahead, Cesar.
Well, going one of the main points, Daniel, that attract my attention is specifically this point about the worldwide income. I know this, at least for us, as our tax system is pretty old, and the worldwide income is like a tradition here. But how? I mean, there is any do you can you explain to us what do you lose or what is your gain if you cut with the worldwide income and just start with the territorial system in a place like us? I mean, we are really connected with the international facts, and we will really need, and especially in those times, right, to attract foreign direct investment.
So I think it's, a lot of territorial systems have come about because countries are capital exporters. They want their companies, so for the U.S., wants U.S. companies to be able to operate in different markets around the world and compete with international other companies in other jurisdictions. The switch from worldwide to territorial can be really meaningful for a capital exporting country. It could also be significant for a capital importer, especially if that country has businesses that are looking to be, worldwide players. So in a way, a worldwide system might be putting Chilean businesses at a disadvantage in other marketplaces, to the extent that there are companies that may be wanting to invest in other parts of South America, or having activities on other continents. What the switch means, though, there's a trade-off. It's not just a simple change, but the switch from a worldwide system to a territorial system is one that comes about with the risk of profit shifting, essentially. So if you say to Chilean businesses that if you have profits anywhere outside of Chile and you send dividends back to your Chilean headquarters, there won't be an additional layer of tax, then there's a potential for those Chilean businesses to set up all their foreign operations in a very low tax jurisdiction and then send those dividends back to Chile. So there's a challenge with designing anti-base erosion rules, which the OECD has had a whole, almost a decade worth of work on, to build in kind of defense mechanisms against that. But essentially, it would allow businesses in Chile to be able to operate foreign subsidiaries in, Australia or Brazil or wherever, to be able to say, we know that we can send, whatever taxes we pay in this foreign location, once we send those dividends back home, there's not an extra layer of tax. So if you're operating a business in a jurisdiction that has a 15% corporate tax rate, there isn't the top-up tax when it comes back to Chile. And I think that's one of those things that creates kind of neutrality. So the foreign business, the Chilean business's foreign subsidiary would be competing on an equal footing with domestic businesses and whatever that other country is, and not have to worry about the increased tax cost of the profits being sent back to Chilean shareholders.
Let me just explain what happens in reality with Chilean companies that go to invest abroad. Direct investments, setting up subsidiary companies, and so on. And from this point of view, if you compare Chile in a worldwide scenario, we are not a capital exporting country. But if you go to Latin American reality, we are. You have many Chilean companies that, since the size of the Chilean economy is not too big as compared to Peru, Colombia, Argentina, Brazil, and so on. So you have lots of, for the last 20 years, Chilean companies going, to look for more market in the continent, in our subcontinent, Latin America. And from this point of view, you do have neutrality in general. In what term? When dividends are brought back to Chile, the amount of taxes and the right of tax credit that you have, and then it normally totally offsets the local corporate tax rate. So you don't end up paying taxes for the repatriation of these dividends. But however, so I would say, if you go to the big numbers of tax authorities, they will not see a lot of taxes paid due to offshore dividends, right? Dividends brought from offshore. So, but then the complexities of those audit processes and the number of hours that they imply for tax administration and for the taxpayers are huge. And every time that you want to offset a local tax with offshore credits, you do have a tax audit. You always have, and the amount of documents and time and so on, it's increasing, and it's amazing. I mean, so it's very inefficient. And since you don't have tax recollection on the one hand, and you are spending lots of time from both sides, taxpayer and tax authorities, it doesn't make sense at all. And you could, as Daniel was explaining, and we've seen this in the case of the first countries that moved, to exemption system and not credit systems, the Netherlands, Belgium, the UK, and so on. You do have policies and rules where if you're bringing dividends from low jurisdiction taxations, then you may have your tax, right? And the point is, where do you put the threshold? And that's it. And that is something that you can discuss. But the situation we're having in Chile, it's totally nuts. And that's my point of view.
Yeah, and I think that's important to consider whether that design decision, the credit system versus the exemption system, would be able to really switch the challenge from the auditing and the complexity to be able to get those credits to something that's just more straightforward.
Yeah.
I mean, even the Germans did. So
right.
That was, for I know, one of the last European countries that moved from the credit system to an exemption system. So I think that's something that should be, looked deep into.
Well, another issue, Daniel, that maybe has an important impact on the ranking of Chile and I don't know the other country, but as the corporate income tax is credit for the personal tax here. At least I understand that most of the country moving to the other way around, right? I think that, and I'm not so sure how much the impact will be on that change. I understand that you put it on your slide, right? On one of the slide you put difference. If you go back to I understand as a worldwide income, right? In the United States, if the Joe Biden provisions is legally bind, but how it will be an impact on the ranking if we move on that way.
So I think it's worth kind of making sure I understand exactly what you're saying. So one of the things that I've heard that Chile has been exploring is providing individuals with a credit against corporate taxes on dividends or capital gains. Is that correct?
Yeah.
Mainly dividends, because
Mainly dividends.
individuals' capital gains do not have a credit along. It's that corporate taxes, whenever dividends are distributed, you have this corporate tax credit is a credit towards your progressive individuals taxation.
Sure. So we call that an integrated corporate tax system.
Sure, we are,
personal,
and one of the problems that I was explaining regarding these last tax reforms that we had a 100% totally integrated tax system up to 2016. And then we ended up with a sort of combination of two systems, a 100% integrated system and a partially integrated system. And whether you could use the 100% of the credit or just a 65% of this credit depended on the company that was distributing dividends and so on. But you couldn't control exactly whether you were investing in a company with one system or the other. So that was a disaster, a total disaster. And
I just your face, Daniel. Even for us, it's really complicated to explain this kind of thing. And the other is especially if you have it's different if you have a double tax treaty with a country. You know, you have the 100% of the credit. But even though even for us, it's difficult to understand and difficult to explain those for people.
So the issue is that it's not only a matter of complexity, but whenever you're evaluating a business, you cannot count that you would be in one system or in the other one. You see, so if you want to calculate the total tax burden, then you really don't know what it will end up. You see, right. And that's it's a pity that we ended up like that. We could have solved our tax collection problems and perhaps the inequality of our tax system in a different way. You could end up in the same, GDP points of tax collection as compared to the whole GDP, to Chilean GDP, and with a different solution. So the outcome was a disaster in the end. And so the current government came in with the idea of eliminating, this distortion. But in the end, politics came in and they had to negotiate something to get this reform approved. And we had some other social problems in between and so on. So the problem still exists.
Yeah, I think with respect to that's really helpful background. But with respect to what Cesar was talking about, President-elect Biden's tax plan, we don't have an integrated system in the U.S. There have been a lot of proposals for an integrated system, but if capital gains and dividends rates were to go up like the Biden plan proposes, there's no offsetting credit for corporate taxes already paid on dividends. I think an integrated tax system is a good policy measure. You see that in the Australian franking credit. You see it in the way that a couple other systems are designed. It's similar to what the Estonian system has, but they're fully integrated on the individual side. Essentially, no business level tax until those dividends or shareholder payments are paid out. But essentially, it gives more clarity to the net tax on business profit, business income, so that you're not just layering taxes on top of each other, but there's a credit for existing taxes paid, and you can adjust the rate for whatever like you were talking about, Eduardo, other concerns that you might have, whether it's inequality or the misalignment between treatment of capital gains and personal income, or treatment of dividends and personal income, but allowing for that credit for taxes already paid at the business level makes a lot of sense.
As far as I understand, Daniel, of the index, at the end the corporate income tax is they don't have a big wave on the ranking, right? I mean, there is no connection of the position that you have in the ranking between the corporate income tax, but which is different from the personal income tax, right?
So I would say the rate itself, the corporate tax rate itself, doesn't have a whole lot of weight in the index, and that's just because it's essentially one variable out of a lot. And since every variable is essentially treated equally, then just one variable doesn't do a lot. What I would say is very important, and you can see this in a lot of the variables in the index, is tax-based design. And on corporate taxes, Chile ranks rather poorly on business investment treatment. So for a business that's going out and purchasing machinery or new properties or building a building, Chile's depreciation schedule, the straight line depreciation, 40 years for a building, 15 years for equipment, those depreciation schedules are significantly longer than what you see on average in OECD countries. And Chile does not provide a deduction for acquired intangible assets. So if a Chilean business were to go out and buy a patent, there's no cost write-off for that patent. And that's very out of line with other OECD countries. From an economist standpoint, the best treatment of business investment is what we call full expensing, immediate cost deduction, not having to deal with 40 years or 25 years or 15 years, but immediate cost deduction. And that's because the timeline over which you're doing those, 15 years worth of deductions, inflation is happening. There's other business investment opportunities that you could be investing in, but rather you're slowly writing off the value of these assets.
Yes.
So a lot of countries, particularly with intangibles and equipment and machinery, have provided very quick write-off systems, either immediate deductions or maybe 5 to 10 years.
Some comments for this. In this last tax reform that was approved in February this year, 2020, for small and medium companies, we do have an immediate depreciation system that should work very well. I mean, we would see because it's still the next tax return that with this will be applicable is the current calendar year, right? Fiscal year. But in the midst of the pandemic, one of the measures, I'm pretty sure that Ministry of Finance had this point very clear, what Daniel was explaining. One of the first measures that they approved in Congress, and it's valid right now, is 100% depreciation of all the assets invested in, but only within a frame of time that ends in 2022. So it's a way of, let's say, a reactivation measure, yes. And it would be very interesting if we could discuss what would be the tax recollection consequences if we have this as a norm, as a permanent rule, and not only as a pandemic rule. That's one comment. And the second one, is like our depreciation system, the normal one is outdated because it was designed for an industrial economy, right? Where you bought machines and where you build, premises and so on, where hard assets, fixed assets, where, the generating income, assets. And in digital economy, more or less, everything is right, intangible assets, right? This is what makes you earn money today. So I'm pretty sure that that's something that we should check and move towards.
Eduardo, do you have any idea of if this measure about the tangible assets and it's working right now? I mean, do you think that the investor, both domestic or international,
it's something that we will have to assess and value probably next year after this first closing in December 31st in our fiscal year. And so I don't have a clear answer to your question right now. But what I do understand is that this was a big discussion in Congress, in our Senate, because government wanted to push for a broader intangible depreciation system, and the opposition wanted, a narrower depreciation. So we ended up with let's say something midway. And we will see how many companies will use it and so on. That would be something very interesting to check later on. What was the economic consequence it generated, right? To see if we could extend that policy. Probably that would be a discussion for next government and next Congress. But not everything is bad news. And here I have here a second good news, and is that before starting this podcast, we were having an internal discussion with César and Daniel, and Daniel was explaining to us the importance of the tax base and how probably the one of the aspects that led to the lower qualification that Chile has in this index is our tax base, our corporate tax base. It is too broad, and from that point of view, one of the main aspects of this tax reform that entered into force in February this year is the definition of the expenses and which are the requirements for having a deductible expense. And we came from a very broad, let's say not broad, sorry, the opposite, a very narrow definition, where a deductible expense was defined as something, a sort of expense that had to be totally indispensable, and meaning, for instance, that the annual celebration of a company, when the money that you would spend, right, in this lunch, in this closing lunch and so on, would not be considered a deductible expense because it was not indispensable. And now we move to a definition that is very close to what Australia has in its tax code and what New Zealand have in their tax code. We had an earlier conversation with people of the Ministry of Finance and tax authorities that intervened, in this drafting of this new concept of deductible expense, and they told us that they look very deep in these two definitions, New Zealand and Australia, and where we have today would be more or less like a sort of combination of those two pieces of legislation. And tax authorities also they published the ruling that refers to this tax amendment, and there's also an enormous number of elements in those rulings that tend to think that, at least in this aspect, in this particular point that Daniel was explaining, that is a very important one within the ranking, we should have better news for next rankings.
Yes, so I think you're absolutely right. We have so some of the data that we use in the report, we develop in other reports throughout the year. And one of the reports that we develop throughout the year is capital cost allowances, these investment depreciations, and we put that report out every spring ahead of the international index. And I think noting what you just said about the, like you said, a relatively narrow depreciation allowance for intangible assets, and then the temporary 100% depreciation. I think those are valuable things. But to your earlier point about the kind of switches between tax rules and former governments going one direction and recent governments going a different direction, temporary tax policy is almost never a good idea. And it's not really, I would say investment allowances aren't necessarily a good stimulus tool even. So certainly you can have some businesses that will make investments because this temporary depreciation allowance is there. But a lot of times it's, businesses shifting plans that may have happened in 2022 to 2021 or from 2021 to 2020. So you're not necessarily increasing the overall level of investment in the economy. Now, certainly what we think about in economic terms is the cost of capital. If you are permanently lowering the cost of capital, the cost of investing through an immediate depreciation system, or even just a shorter depreciation schedule, then that is something that can influence long-term investment trajectory. Sure, it may be a government priority to have investment that would have happened in 2021 to happen in 2020, but I think it's worth thinking about in kind of the longer-term trajectory of these things. This was a pretty heavy critique that Tax Foundation gave to the U.S. government with the current depreciation regime in the U.S., which starts to phase out in just a couple of years and then will expire. And the critique was that it's much more valuable to have a permanent policy and maybe even a slightly higher corporate rate to be able to have the ability for businesses that, businesses plan, 10, 15 years out for some large projects, of course, for them to be able to have tax certainty over that window when they're making those investment plans. And especially for, we certainly, talked a little bit on the intangibles about the new economy, but one of the things that comes along with the new economy is some very capital intensive businesses. So if you think about telecommunications companies, these are some of the companies that have the highest, some of the highest capital expenditures in the U.S. And even globally. Building new cell towers, building out new, Wi-Fi networks and things like that. It's really important to be able to have treatment of that business investment cost in a way that really helps them to do that without really high cost of capital.
I've even seen systems like, I'm thinking in Belgium, I'm thinking in Brazil, that is it's not a good example in general in terms of neutrality and correctiveness and an easy way of doing businesses in general. But in both jurisdictions, you do have an expense within the company of the capital that the shareholders have poured in. So capital contributions, a year fixed depreciation is an expense. It's an ordinary expense, and you can deduct it every year. And that is something very interesting. I've seen it, and it works in reality.
Yeah, I think features like that, and what has happened in a couple of countries, and this may be similar to what you're talking about, is an allowance for corporate equity or a notional interest deduction.
Yeah. Mm-hmm.
Yeah.
So from an economic point of view, it's the same thing. But yeah, in Brazil, for instance, it's an interest payment, let's say. Mm-hmm. But yeah, you can deduct it within the company, right?
Yeah, and the value of that is to minimize the bias in corporate tax systems towards debt financing. Debt interest is a deductible expense, whereas for capital or for capital finance that's equity financed activities, there's not a connected expense. You have to deal with depreciation schedules and things like that. There's not a deduction for the cost of raising that equity. And that's where the notional interest deduction or the allowance for corporate equity comes in. Because a lot of times, in countries all around the world, you'll see, especially larger companies, gearing their capital structure towards debt. Now,
sure, it happens in Chile with multinational companies. Normally, they would try to pour in as much as debt as possible in their Chilean structures.
Yes, exactly, and that creates an issue with both, a problem with debt overload and the different, financial crises we've seen throughout history and things like that. But also, it can create a challenge with, base erosion and profit shifting. You can see, debt being loaded up in high tax jurisdictions.
Tax treaty shopping, tax treaty abuses, and so on. And normally are things that, even though you may have anti-avoidance rules, always authorities are behind, right? So you can never expect that these rules will take tax planning away, and that people will only, due to these rules, capitalize fully their Chilean subsidiaries. I mean, that's
right. And I think it's important that the different debt and equity biases that you see in tax system, different companies are able, certainly larger multinationals may be able to load up on debt, but more entrepreneurial growing businesses, they're having to go to either local, venture capital or going to their own bank accounts to be able to fund these different types of investment and to minimize any tax burdens or I'd say tax barriers to growing companies is really valuable.
Yeah, very, very, very interesting.
Daniel, what would you say that it are in a general point of view, from Chile perspective? I mean, you think which are the problem that the Chilean tax system has at this time?
So I would go back to the thing that we were just talking about on depreciation allowances, and maybe trying to take some of these temporary measures that have been taken and make them more permanent, or having a compromise between the old and the new system that is a permanent policy, lowers the cost of investment for the long term. I'd say one of the things that shows up in the index, and this isn't our measure, this is a measure, a survey measure by PwC, and I mentioned this in my initial remarks, is just the compliance costs. It seems like there is just a very high amount of time and just general cost invested in complying with the Chilean rules. A lot of countries have been able to digitalize their tax systems to lower compliance costs and things like that. I don't know if that's something that makes sense for Chile, or if that's an effort that's already in process. But it seems like the compliance burden is just as significant as the overall tax policy design, as far as a challenge for
today. I would say that today probably perhaps is twice as much as it used to be 10 years ago, and this is a result of the new complexities our system has nowadays. It's something that our policymakers have not taken too seriously, I would say.
And as a matter of fact, Daniel, I let you know that in Chile there is a competitiveness between economists and lawyers, because our Minister of Finance have some meeting right now with economists, just to talk about how the next rules and which is the path to Chile. I mean, to improve as a really a full new tax system, and only economists are invited to that party. What do you think about it, Daniel?
I'd say it could be it could go two ways. One, economists love efficiency. They love a policy that is able to get the result that's intended. And do it in as few steps as possible. So if the goal is to simply raise funds for the budget, then you're going to get, you're going to be able to design a tax system that does that. And economists will point to, the different levers that you have. One of the things that will be competing with that, however, and this is common among economists as well, is that you want not just efficiency, but equity. Being able to talk about like what was mentioned earlier with the Gini index, or thinking about lower income families, or higher taxes on higher earners, and those trade-offs are really significant. But I think it's valuable to look at, again, this is where the international index can be kind of a good tool for policymakers, be able to think about, okay, what country has a tax and spending or welfare kind of system that you would like to emulate? What level of tax revenue do they need? How have they designed their welfare system? And be able to say, okay, well, it looks like we can design a relatively efficient tax code and to be able to do this equity policy as well. To be able to match those two kind of in a reasonable way. I think it's much more important to get the efficiency right on the tax system and be able to build in some of that, redistribution or other elements on the spending side, because the tax system is good at raising money. It's not as good at redistributing incomes. That's what spending programs are much better at.
Right, Eduardo.
No, actually, what Daniel was explaining, I've had discussions with economists, and this is not really a tax discussion, but rather a full policy-making discussion. Even though we have a tax collection in Chile, it's a decent one. It's not a low jurisdiction one. After the spending, the Gini index moves very, very little as compared to some other countries. And the discussion I had was Holland, comparing Chile to Holland. And after the expenditure, their Gini ranking moved quite a lot, almost like one foot point or comma one, right? And that brings us to a totally different discussion. But how are we spending the money, right? And how is social spending being done by our bureaucratic system? And we have a big issue that needs a deep revision as well.
Wonderful. I don't know if there are any topic that is we will keep it on the next program. Daniel and Eduardo, I think that this is a really interesting point, and I'm happy that we can discuss about it. So I just want to say thank you, Daniel, and many thanks for all your effort, your time that you spend with us, and Eduardo also many thanks. From my side, I really appreciate all your time, guys. Many thanks. It was wonderful for me.
Thank you, Cesar. It was very enjoyable. Thank you.
Same for me. Thank you very much for this interesting conversation.
Okay. Thank you, and thank you all, guys. Many thanks and let's see in our next show, next program. Many thanks.